No matter what your technical analysis may tell you, it's fundamental economics that drive the currency markets. Being in the know of these events, the strengths, weaknesses, and the upcoming economic factors can give traders a huge edge in the markets. With that being said, trading the news is not easy and very few traders can do it consistently. In fact, many traders get caught on the wrong side of news releases. So, in this video, we're going to look at exactly how you can trade the news and what to watch out for. Let's get into it. Trading is about much more than just drawing trend lines on a chart. It's primarily about the fundamental economics that drive decisions and influence the value of currencies. To give yourself the best possible edge in the market, it's important to be at least aware of how news events can impact our trading. There are, on average, about 15 high-impact news each week, 99 medium-impact releases, and about 300 low-impact ones, all of which have the power to influence every single trade you take. So we have three options when it comes to news releases: ignoring it, combining it with price action, or setting orders for when the news is released. Let's weigh up these options. Our first option is by far the easiest. This is the option that 90% of traders tend to lean towards. Just ignore the news completely. This means that you will, for better or for worse, stay in all your trades during the news releases, and we'll just see what happens. You would know the edge you have in the markets over thousands of trades and you play your edge. But we've all been in trades before where the price suddenly moves 100 pips towards our stop loss or take profit. This is usually because there is a news release. I wouldn't necessarily recommend completely ignoring the news, as they can leave you with a lot of risk that you may be completely unaware of. This option is the most favored one amongst experienced traders around the world, using the news in addition with price action confluences. So what does this look like? An example would be here on the USD CAD. You can clearly see a supply zone on the 4-hour time frame using conventional technical analysis. We also knew that there was going to be the unemployment rates released on this day. Dropping to the lower time frames, you can clearly see the impact the news had on the price of USD CAD after touching this order zone. Now, price action and technical traders would claim that this trade won purely due to price being inside of the supply box. Fundamental traders would claim that the price moved purely down to the unemployment rate numbers, and they would be right. However, this doesn't mean that you should be a purely fundamental trader. If you had combined both technical and fundamental analysis, you could have entered a short position in the supply zone and held it through the news release, then into the break of the previous low. I recommend doing hundreds of backtests of news releases and see how the price action reacts to simple technical analysis. This is certainly an important step in creating a bulletproof trading strategy to pass a proprietary firm evaluation. Our last option on this list is just waiting for the news releases and only trading when they happen. It must be noted that this is by far the riskiest option of the three, and you can easily blow through your entire trading capital in just minutes. In fact, this approach is a bit more like gambling. Let's have a look at it. Here is the impact of the JPY interest rate decision just before Christmas in 2022. If you had set a bullish pending order above market price and a bearish below, your bearish order would have been triggered and you would have made a huge number of pips as a profit. Doing this on high impact news releases could yield great results sporadically. However, typically you'll notice that the price whipsaws and you would get triggered both on your buy and your sell order. Compound that with the fact that you're going to be getting a huge amount of slippage, and this means that you're likely to lose 3 to 4R. This will lead to a giant level drawdown and bring a huge amount of psychological pressure with it, making it nearly impossible to objectively trade in this manner. Again, this is something that you should be heavily backtested before you even think about becoming a news trader. That's because the risks taken when trading during the news are pretty huge. If you're looking to reduce your losses and your risk trying to pass a proper evaluation, I don't think trading during the news is the best option for you. We've learned that trading the news can be both advantageous and disastrous. Although it can create spectacular opportunities for traders to make a quick buck, the risks often outweigh the rewards. And when it comes to our funded traders, we'd highly recommend for traders to not get involved during high-impact news releases. This either means being flat at the time of a release, or at least not actively setting pending orders around the news release. The reason for this is simple. If you blow through your funded account's maximum loss, you'll be set back, which is entirely possible with the increased volatility and slippage that occurs during the news releases, where you should have most likely scaled down as the risk is too large. You would have to spend weeks, if not months, getting back to trading the same amount of capital as you were before. All of that for a single trade where you should have probably not entered the markets because the risk is too high. Well, thank you for watching today. I hope you've learned something. If you have any questions, feel free to leave them down in the comment section below, or message our 24/5 live chat, or send us an email at info@luxtradingfirm.com. If you'd like to chat with our other traders, join our Discord channel. The link is down in the description, and I thank you for watching today. Mine has been Oliver, and I'll see you in the next one.